Welcome to Celebrity Investing, your go-to source for insights, tips and updates on navigating the exciting landscape of personal and global finance. Please like, share and subscribe for more exclusive content. This is part 1 of Unraveling Callable Bonds. Everything you need to know about risks and rewards. Ever wonder about the buzz around callable bonds in the financial market? You're in the right spot to figure it out. Callable bonds offer unique opportunities and risks for investors, and they're not just another entry in the bond market. These bonds allow issuers to redeem them before the maturity date, giving them a flexible financial tool. But what does this mean for you, the investor? In this video, you'll learn what makes callable bonds tick and how they could fit into your investment strategy. Discover their potential benefits, such as higher yields, and the risks, like reduced price stability. Get ready to see if callable bonds might be the missing piece in your investment puzzle. Understanding callable bonds. Callable bonds might seem like just another financial term, but they pack a punch with features that can make a real difference to investors. Issuers can redeem these bonds before they reach maturity, offering flexibility but also presenting certain risks and rewards. Knowing what makes callable bonds unique is key to determining if they're the right fit for your portfolio. Characteristics of callable bonds. Callable bonds are defined by specific traits that differentiate them from other bonds. Call date. This is the date on or after which the issuer can redeem the bond. It's like setting an alarm. Once it goes off, the bond can be called. You may find various call dates, each presenting a potential redemption point. Call price. This is the price the issuer pays to call the bond back. It's usually above the bond's face value, serving as compensation to the investor for the call risk. Think of it as a small bonus for having your bond's life cut short. Coupon rate. Callable bonds often come with higher coupon rates compared to their non-callable counterparts. This higher interest is the issuer's way of sweetening the deal, compensating you for the call option they hold. Together, these characteristics create a dynamic where issuers hold the cards, able to call the bond if interest rates drop, allowing them to refinance at lower costs. Difference from non-callable bonds. When you put callable and non-callable bonds side by side, the distinctions become clear, especially regarding risk and return. Risk level. Callable bonds carry the additional risk of being redeemed early, which non-callables don't have. It's like booking a flight that may get cancelled. For non-callable bonds, risk primarily revolves around credit and interest rate fluctuations. Returns. Because of the call risk, callable bonds often offer higher yields than non-callable ones. It's a trade-off. You're getting a potential higher return in exchange for the uncertainty of when you'll get your principal back. Price volatility. Callable bonds can experience more price volatility, especially as interest rates change. If rates drop, the odds of a call increase, impacting the bond's price. Non-callable bonds provide more price stability since they will only mature at the end of their term. Understanding these differences helps you weigh the potential for higher income against the uncertainty that comes with callable bonds. This knowledge is crucial when deciding where to place your investment dollars. How callable bonds work. Diving deeper into callable bonds reveals a world where issuers have the power to change the bond's course midstream, and investors must stay informed of their rights. Understanding the mechanics of callable bonds can provide clarity on how they can impact your investment strategy. The calling process. The primary allure for companies issuing callable bonds is their ability to call or redeem the bonds before maturity. But how exactly does the calling process unfold? Timing and terms. When a callable bond is issued, it comes with an initial period during which it cannot be called. This is often referred to as the call protection period. After this period, the issuer has the freedom to redeem the bond. Call dates are predetermined and outlined in the bond's contract, which means you'll know precisely when a call might occur. Notice periods. Issuers don't just wake up one day and decide to call a bond. They must adhere to a notice period. Typically, investors receive a call notice 30 to 60 days before the bond is redeemed. This buffer gives investors time to plan their next steps. Why call? The driving motivation for issuers to call bonds usually ties back to interest rates. If rates have dropped since the bond was issued, the company might choose to issue new debt at a lower rate, a smart move to cut their borrowing costs. Investor rights and protections. When investing in callable bonds, it's crucial to know what protections are in place to safeguard your investment capital and your returns. Right to full payment. Investors maintain the right to receive the full call price, which usually exceeds the bond's face value. This premium compensates for the early termination of the bond contract. Disclosure of terms. Callable bonds come with clearly stated terms and conditions that must be disclosed at the time of purchase. This information helps investors assess risks and potential returns, ensuring you're not in the dark about your investment's conditions. Alternative strategies. Investors can use callable bonds as part of a broader portfolio strategy to manage risk. Centato's laddering technique involves purchasing bonds with varying maturity dates to hedge against the uncertainty of calls. By understanding these mechanisms and your rights, you can better navigate the landscape of callable bonds and make informed investment choices. It's not just about chasing high yields, it's about grasping the nuts and bolts of how these bonds function in the real world. Benefits of callable bonds for issuers. Callable bonds offer significant advantages to issuers, especially in terms of financial strategy and cost management. For organizations, these bonds act like a financial tool set that they can use to their advantage. Let's explore how exactly they benefit from callable bonds. Interest rate management. Managing interest rate risks is one of the primary perks issuers enjoy with callable bonds. Think of these bonds as a safety valve for when interest rates shift. When interest rates fall, the cost of borrowing decreases, yet bondholders still earn the initially agreed-upon rates. If a company has issued bonds at a higher interest rate, a decline in rates means paying more than necessary to bondholders. Here's where callable bonds come into play. Cost control. Issuers can call these bonds and reissue new ones at lower rates, trimming excess interest expenditures. It's akin to refinancing a mortgage when rates drop. You get a better deal by lowering the cost of debt. Flexible strategy. Callable bonds provide a shield against fluctuating rates, giving issuers the flexibility to adapt their strategies without being locked into high interest payments. It's like having an adjustable wrench in your toolkit, always there when conditions change. Refinancing opportunities. Callable bonds shine a spotlight on refinancing opportunities, allowing issuers to optimize their financial standing. Consider it a financial reset button that companies can press when the conditions are right. Access to lower rates. When the market favors lower interest rates, companies can quickly pivot, calling in their existing high-rate debt and replacing it with lower-rate options. It's a way to save money and improve cash flow without complicating financial standing. Reduce debt burden. This ability not only lowers interest expenses, but also reduces the overall debt burden. By refinancing, issuers can allocate extra funds towards growth, research, or other investments, paving the way for innovative pursuits. Market responsiveness. Callable bonds offer a strategic advantage by allowing issuers to stay nimble. They can respond dynamically to market changes, seizing opportunities to strengthen financial health. In essence, the benefits of callable bonds extend beyond mere flexibility. They are a core component of a sophisticated financial management strategy. For issuers, the ability to manage costs and capitalize on refinancing can result in significant long-term savings and stability. Risks for investors. Investing in callable bonds presents a unique set of challenges that every potential investor should fully understand. While these bonds might seem alluring due to their high yield potential, they also carry risks that can impact your financial returns. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.